this morning, late August 24th, with Mark Shore. Mark is, I would guess, the president and CEO of Shore Capital Management, which is a research boutique firm out of Chicago. Mark, thanks for coming on. I appreciate you taking the time this afternoon.
Thank you. Very happy to be here.
Yeah, so you're in Chicago. How's the humidity levels late summer in Chicago?
Actually, it hasn't been too bad. It's been earlier in the summer where it was pretty hot and a lot of rain. But actually, for August, it's starting to feel a little bit more like September, oddly enough.
And that is definitely my favorite time of the year. As a Midwest kid, grew up in that area. I love September. Are you a football fan, Mark?
No, not really.
Not really. Okay, so we don't have that in common. So listen, you are recently an adjunct professor over at DePaul in the great Chicago heartland there, right downtown, and you're teaching a managed futures course. Is that correct?
That is correct. Yeah, I started teaching it last quarter. I'll be teaching again in the fall, and the idea is to bring the concepts of managed futures. I mean, you have futures courses that are taught within universities,
right,
teaching about for pricing theory and about hedging, but there isn't a whole lot that's really talked about managed futures or futures as an asset class to invest in. Talking to a lot of people in the industry, this may actually be the first university credit course on managed futures.
So tell us a little bit about that. That's, because again, I think this is going to be a growing area, CTAs, and I know in your history, I want to get into this a little bit. So let's go back just a step before we get into the class and the coursework that you're teaching, because I think this is very fascinating. And again, unique in that you're teaching a class that really is not being taught. It's difficult to find trading classes anywhere. I think, the best trading experience always comes from doing it yourself, and it's difficult to learn without somebody else's money, obviously, if you're a student. So you were the COO of a pretty good-sized CTA at Morgan Stanley. So give us a little flavor on that and how long you were in that capacity and kind of what that meant.
Well, I was there for about 9 years, started out as a researcher developing and enhancing systematic trading models.
Okay.
Eventually became the COO, so I was now overseeing the research. Responsibilities, and also I was doing a lot of traveling with the wholesalers around the country, giving presentations to both brokers and clients. Also going outside of Morgan Stanley, getting us onto the radar screen of a lot of institutional investors. The CTA itself had been around for about 19 years. It was in existence for about 10 years before I joined it. We had about 250 million management, traded about 35 different markets, systematic, trend following, pretty much that style.
And so, yeah, pretty much, again, trend following macro type fund. Most of your positions were, longer in scope, 6 months to a couple of years and type of time frame.
No, actually they were a bit shorter. They would be anywhere from a few weeks to a few months.
Okay.
Some positions, we were more of a moderate trend follower.
All right.
Short or losing positions may last anywhere from a few days to a few weeks. Winning positions would go anywhere from a few weeks to several months. I see.
And would you say that with those types of strategies, Mark, that they could be utilized and followed on any time frame? I mean, the things that the fund was doing, could you use on a smaller time frame all the way up to a monthly time frame? You just kind of chose to play in that middle area, the smaller area?
Yes.
Yeah. And I'm curious your thoughts on this, because as a futures trader myself, I tend to believe that. I tend to believe that, if I were running a CTA or if I were running a fund, I might have multi-time frame strategies amongst various vehicles. Like you said, your fund had 30 different things that you were following. And did you find that you maybe, were long on one time frame, short on another, or were you all playing the same time frame, always kind of playing the same way all the time?
The time frame was pretty much the same for what we were doing. We were also starting to develop some other trading models where there was some variation to that. But it could be that we, could be long in certain markets, short other markets. So in essence, it may look like we're spreading, but we weren't, because we were just doing each market, on a directional basis.
Okay, so explain to our viewers what you mean by that. I understood that, but, versus a directional bet versus a spreading bet. Let's get into that a little bit.
Well, directional may be, you're looking for a market to go one direction. Either from where you get in, you're going long, you're looking to go higher, or you're going short, so when you get to it, you're looking for it to go down.
Right. When
you're spreading, you're trading two different markets, or two different months of the same market. So with that, let's say you're long corn and short soybeans. It may look like a spread, but we're not doing it to try and do it as one position as a spread, but we're just getting signals in each of those markets, one to go long, one to go short.
Yeah, so they were independent trades, as you said. You weren't really playing one off the other. You just got a short signal on the oats and the soy, and you were long on the corn. It just happened to work out that way. So, whereas there are some funds probably that very often do a lot of spreading techniques and will play one market versus the other and try to hedge and kind of pinch that difference in between there, be long one, short the other, et cetera.
Yeah, you do see some funds that will do that. You also see some funds that will, kind of coming back to your idea about different time frames or using different strategies. Maybe they have a core strategy that perhaps that's what they started their fund with, and then over time they started to realize there may be some weaknesses or things they could do to improve it, so they then add on another system. Maybe they give that other system or a couple other systems, maybe each 5, 10, 15% allocation. They keep that core system, maybe 60, 70, 80%, and that helps to smooth out their returns.
Mm-hmm. Mm-hmm. Now, you're bringing up kind of an interesting point in that you're not necessarily talking about style drift, but as a fund continues and grows and manages, there obviously can be some limitations on maybe sizes of positions that a fund can put on. So again, I'm just trying to ask you a question here where, we're not necessarily talking style drift, but, maybe, when you started a fund and maybe that fund when you were at Morgan Stanley maybe started with $25 million, you got up to $250 million. Did you have some ideas in mind as far as the scale of what could be managed by that fund?
From our initial portfolio, our initial strategy, we had ideas as to where capacity is. That's always an issue too when you're talking to money managers.
Yeah.
Depending on what markets are trading, the style they're trading, are there capacity issues they're going to reach? Some may find at $50 million they're going to hit capacity. Others may say at $1 billion they'll hit capacity.
Right.
And that's something too. As a manager, you have to think about for the long-term ability, the longevity of the business. Do you create other funds? Are there things you can do to enhance what you have to create greater capacity?
And you also, I would say, if you were talking to a fund manager on the CTA side, on the managed future side, you'd also have to consider, capacity along with style drift. Are you getting away from your core principles here, and is that bringing some possible slippage into the overall performance, or possibly even enhancement, by adding, as you said, additional strategies, Mark? These are things that fund managers, like you said, need to consider. Before, during, and afterwards. I think when they build these types of funds, is that there are capacity constraints, or there can be. If you're trading the S&P versus soy, S&P capacity is really not an issue. You could be trading billions and really not have too much effect pretty actively. But if you're trading oats, that's a whole different story. It's just not as liquid of a market. It's not as wide.
Exactly, and that brings up another point too, because you'll see some managers who'll say, we trade 50, 100, 125 different markets. However, some of those markets can be very thin, and when they're small, that's fine. It has a greater component to their returns.
Right.
But as they grow, they can't maintain that same sort of percentage of allocation to those markets.
Sure.
So in essence, it becomes a smaller and smaller piece of what they're doing, and then you have to look at the markets where there's real volume and liquidity and say that, potentially that's where the real returns are going to come from.
So give me the difference, for the person looking at, say, CTAs and hedge funds. Give me and I'm kind of lumping in, and you can tell me if I'm wrong here. Would you consider a CTA in the same vein as a managed futures account? First part of the question. Then second of all, how do those vehicles differ from the traditional hedge fund, which, again, aren't so traditional sometimes anyways, but, give me the differences in your mind of a managed futures / CTA versus a hedge fund.
Well, a CTA is within managed futures industry. I mean, that's basically what they're doing. They're trading futures markets, futures, options, maybe some forwards like in the Forex markets. They're also regulated, so they have that. I mean, they're trading on markets or on exchanges.
Right. So
they have that liquidity, by the end of the day or intraday what the value is of the positions. And it's more of a macro view. Hedge funds, a lot of them are going to be more of equity-based strategies. They can be fundamental. They could be technical. They could be quantitative. They pretty much are open to trade whatever they whatever they want or wherever they want. Often not regulated. That's starting to change. I mean, there's a lot in D.C. as to what's going to happen with that, so it's still a big unknown. But you have those types of issues. Liquidity becomes another issue. CTAs are very liquid. In 2008, CTAs were one of the few strategies that were making money. They were also one of the few strategies that had easy liquidity. Right. So when people couldn't get out of hedge funds, they were, liquidating. They were redeeming from CTAs. So it's a double-edged sword.
Right. Well, you hear that a lot. I talked to some CTAs, and they're, like you said, they performed as a macro unit very well, as you said, in these difficult market periods, which says a lot for that. But I also talk to a lot of managers who say, during those periods where my investors were also in the fray of hedge funds, equity hedge funds, options hedge funds, and were maybe long only or fundamentally driven hedge funds, and were taking big hits. They found a lot of their investors leaving or wanting to pull their money out even after they had successful runs within their own CTAs because of, again, kind of a industry margin call, I guess, in their other funds, and they were feeling the stress. You want to address that? Talk about that a little bit, because I think that's fascinating. The guys that have success, get caught in the fray of the overall market, even though they perform extremely well, and that causes undue needs to liquidate, obviously to refund investors.
Yeah, I mean that was one of the issues that came up. I mean, it's always been talked about that CTAs are pretty liquid. Depending on how it's structured, if it's a fund, maybe you can get out, intra-month or at the end of the month. If it's a managed account, you can get out at the end of the day or by the next day. So you have that kind of liquidity.
Right.
Hedge funds, often, maybe 60 days, 45 days, perhaps even they could put up a gate and you can't get out at all. So, yeah, it comes back to, well, then if you're going to have to liquidate from somewhere,
right?
If you're getting margin calls or having issues, where do you take it from out of your portfolio? And you go, oh, managed futures, these guys are liquid. Let's redeem from them.
Right. And so do you find that's forcing some changes in the game or overall, that CTAs are saying, hey, your money's going to be locked up for, 3 years, 5 years, longer than the typical quarter, or get your money anytime you want, because my strategies need to have time to kind of breathe and be able to, do the right thing that it was set up to do? Is that something that's happening in the industry?
I don't really see that. I mean, there may be some that are out there doing that, but I haven't really seen that as, a major component within the industry.
Right. What about, do you find people investors look at CTAs as not only an alternative and a disconnect from, markets in general? In other words, their performance is not based on overall S&P does well, my CTA will do well. There's definitely it's a non-correlated typically, which is a good thing. But you also find that there are investors looking at CTAs for tax reasons and those types of issues. There's tax benefits trading futures versus stocks and options.
Yeah, I haven't seen much really being said about for tax purposes. It's an interesting question, but yeah, I haven't really seen that. It's really, when people are looking at it, it's for the purpose of diversification within the portfolio.
Mark, I'm not aware, but is there a managed futures index that like the S&P 500 that people can follow?
There's a few different indices. Barclays Hedge has one, which is, they're kind of like the go-to company, as a vendor. Who else has it? There is, CISDM also has one, which is actually more of a research facility or center in Boston. It's an academic center.
Okay.
They also have one. There's a few others which names aren't coming to me at the moment.
Well, do you put much value on them, I guess? I mean, are they something that, guys like yourself, when you were running money like that, did you watch these, or they really didn't matter because you were watching the individual 30 markets yourself, and it wasn't really something that you tried to benchmark yourself versus? I'm just curious how the industry kind of looks at, the overall, because like you said, soy could be correlated with corn, or I might be entirely directional on either side and don't really care. That's why I'm asking, is there any types of these indices that you would find beneficial or people should, point to and look at?
Yeah, you can look at them to get a gauge of where the industry is at, if the industry on whole, and you can also break that up into certain sectors as to some who are systematic, some who are discretionary, some who are forex traders, some who are commodity or grain traders, and you start to get an idea where, some are performing, some are underperforming, and it also starts to tell you, too, that they're not all the same. That was the one question that I've gotten over and over again. It's like, aren't you guys all doing the same thing?
Right.
Aren't you all basically the same? Can't I just invest in one?
Right.
Why invest in a handful of them? And it's because they may be doing different things. Even if you take randomly a group of trend followers, systematic trend followers, how they do that could also vary. That you could have one that trades one market, and maybe, they hold the positions for 6 months, a year, 2 years. You could have someone else that trades 30, 50, 100 different markets, and maybe they only hold positions for a couple of weeks or a couple of months. They may have profit targets to get in and out. To get out, they may have how they may leg into a position, they may leg out of a position,
right.
Maybe purely off of a stop. How they manage their risk comes into play. I mean, there's a lot of different little components in there, plus adding in, are they doing any kind of overlay of another system onto their portfolio?
Yeah, and this is again where, the manager of said fund, as you said, there's a lot of art. Even though it may be mechanical, as you said, they may be in their core very much turtles or trend followers, whatever you want to call them, and so they have the core principles, but the way that they get into a position, leg in or leg out, as you said, how they manage their stops, this is where I think the special sauce is. So. That's the interesting thing.
Order filled.
I think, and that's what differentiates one manager versus the other. One thing I want to ask you, Mark, with the awareness, I guess, in the last 15 years of, equities, buy and hold not necessarily being the, most beneficial, you're obviously seeing some wider liquidity coming into managed futures, wouldn't you say, and CTAs in general? There's a lot more money coming into this area now wanting to take a piece of this?
Oh, definitely. I mean, it's been growing quite a bit. Just in the past few years. What I saw was between 98 and 2000, or let's say the late 90s up to about 2000, everyone was focused on equities. So there wasn't a whole lot of discussion about diversification. Then between 2000 and 2003, people started looking around, looking for more diversification. Equities were kind of going sideways at that time. The economy was slow. So there was greater interest in managed futures. 2004, 2005, 2006, people started to forget about diversification again, going back into equities.
Right.
And then since 2008, I've seen a more serious interest and a lot more coming from institutions, also coming from investment consultants, that there's just people are starting to realize we need to do more than stocks and bonds, and even hedge funds may not be enough. We need to find something else that fits into the portfolio. And what can we do? people are also, they're looking at commodities in general. They're also asking the question of, okay, if we go into commodities, how do we go into it? Do we go into a CTA? Do we go into a global macro hedge fund? Do we go into investing in the physical infrastructure? Do we invest in a long-only commodity index?
Yeah.
So the questions are coming up, which just the fact that they're asking questions is really good.
It is.
And then to say, okay, this is how it can fit into your portfolio.
Yeah, because a lot of people would, even say, Mark, that, I could simulate a managed futures fund by buying ETF indices, or something like that, like the Rogers indices. What do you think about that? Is that a viable way for the retail person to do that? Or would you still say, hey, go to the manager who's in this day to day? I tend to believe go to the guys, like you said, trade the real versus the derivative. That's kind of always been my philosophy in anything. Trade the guy who is right there in it every day versus trying to duplicate.
I definitely agree. I mean, there is a place in a portfolio for, let's say, a long-only commodity index, but it's one-sided. If the market goes down, you're going to have problems. You had people going into it in 2008, and a lot of it was being fueled by the energy markets.
Yeah.
Well, in the summer of 2008, as those started to come down, and investors are going, well, now how do I make money on the short side? And then they go, oh, managed futures.
Right.
Maybe I should look into that.
Right. And with the growth of managed futures, again, do you think that puts a bias on overall markets with that added liquidity? Do you find, I always say, I would think futures traders are probably, futures, Forex are probably the purest traders out there. And I do want to generalize, and I want you to respond to it. Do you think that most futures and currency traders are technical, quant-driven, mechanical, one of those three, however you want to term it, versus fundamental?
I think the majority of them are. Yeah, they use that. A lot of the technicals have been developed for the futures markets. Some of them came out of equities too. But, yeah, I mean, they're looking at more from that perspective. They may look at the technicals and use that heavily, but also complement that with some of the fundamentals and understanding that where potentially this market can go based on the technicals.
Yeah.
And the technicals may take it to a certain place, but but fundamentally this just can't hold up much longer.
But with that, so we just threw out that there, the fundamentals and the technical. So if I'm, if I really think long term that, China is going to drive up grain prices from wheat to corn to soy, and I fundamentally believe that. Obviously, I can buy futures, but another thing, as you mentioned, we kind of touched on this. Do you find some of these CTAs now are actually going out and buying farmland? Really getting into the physical. If you fundamentally believe it, in that macro view. And again, we're just playing. We're doing a little game theory here. But do you find that is happening?
I don't know if actual CTAs are doing that. Obviously,
could they do it under their bylaws? Is that something that they'd be allowed to do even?
As part of the fund, probably not.
Okay. It just popped into my head, and I was just like, well, if I'm really bullish and the fundamentals are there and technicals are there, maybe I take a small piece of my liquidity and I have somebody that I knows a lot about buying value in farmland. I go out and actually purchase it if I'm long, grains.
If they did that for their own personal investment, that's one thing. But to do that as part of the portfolio, unless that was written into it, that they could do that, I don't really see people doing it. I mean, they're trading futures, options, and forwards and sticking with that, and that's where the liquidity is.
So, size of, 200, when you were at Morgan Stanley, 250 million, that's a lot of people go, oh, that's nothing. But when you look in the futures world, that's a big fund. That's a pretty big fund. Did you guys have any problem trying to utilize all that capital, or did you find that to be pretty liquid and really could go up to $1 billion, $2 billion?
Yeah, no, for us, the markets we were trading, it was liquid. We didn't have any issues with it. We figured capacity could easily be about $1 billion, maybe a bit more.
Okay. So again, based on your strategies, trend following, probably heavily, stock market indices, interest rates. These were big pieces of your portfolio. Also, pretty active.
Yeah, we traded energies, metals, grains, stock indices, interest rates, pretty much across the board.
And if you were looking at that same fund today, would it be $2 billion? Again, based on the breadth and the liquidity in some of these markets, how wide they've gotten and how much more money is flowing into them. I look at the grain markets and I'm amazed at, the volume of really the liquidity that's available out there. It's much bigger than it, probably was 10 years ago.
Yeah, no, it's definitely grown. I mean, part of, too, the demand for managed futures is coming out of the demand for commodities. Because as that has fueled in more recent years, people are also looking at, okay, well, how do I get access to that part of it? And you can do that through CTAs.
So when you're teaching your course now, let's swing back to DePaul and what you're offering on your managed futures course. What kind of things, what does your student base look like, first of all? And
well, they're graduate students, so it's in the MBA program.
Okay. And
a lot of them already have some sort of background in investments, either working in it or they've had some previous experience, or it's the direction they're going with their MBA. The class itself, what I'm trying to do is give them overall exposure, what the product is, how it makes sense, pros and cons to it, understanding really what it is, and talking about the overlays, talking about volatility. Mm-hmm. A lot of people talk about that there's a lot of volatility to CTAs. However, what they don't realize is that once you parse up the volatility, a lot of that volatility actually comes from the positive returns, not so much from the negative returns, because that CTAs as an industry tend to manage risk pretty well.
Right. And do you think why is that, Mark? Why do that's a very good point, but I want to hear your take on why you say that.
Well, that's part of how they develop their trading systems. I mean, they use stops. If you're a systematic trader, you're not sitting there and being discretionary about, well, okay, I'll hold on to it a little bit longer. It's going to get to a certain price point. If it doesn't hold, you get out. I mean, you've got that stop in place.
And I think this is also what also separates. I talk to a lot of people that come from the equity world, and they're always, again, initially probably because of what they've been told their whole lives, that volatility and futures, they're scary, but they're more liquid. They're more technically driven, and I always use this example, but I'd rather play with the guys who respect their stops, versus the drunk guys from Topeka at 4 a.m. at the $5 blackjack table, and that's what I term that to me equates to the equity side of the business.
Yeah, I mean that ultimately that's a lot of what this business is about. It's about managing the risk.
Yeah.
And that's really what I try to get across to the students, is saying, here's what they're doing, how they're managing their risk. They take this very seriously, and that's why I come back to understanding the volatility.
Right.
I say volatility is like cholesterol. There's good volatility and there's bad volatility. The good volatility you want all the time, because it's basically saying, it's moving your returns up, it's moving your performance up. It's the bad volatility that you're trying to reduce. And that comes into the whole play about tail risk, about skewness, that modern portfolio theory makes the assumption that you have normal distribution of returns when you don't. You either have positive or negatively skewed returns.
And the beautiful thing about futures is, this is what I always say. If I'm wrong, and I can get back in the same side or the other side immediately. And that's the beauty of it, is I don't have to go out and borrow. I don't have to go out and do the things that I have to do in equities just to play the game. Plus the liquidity, the nature of the markets. Most of the financials are trading, 24/7. Being able to, come into a market when equities are closed is so huge. I mean, you have to trade futures. You can just trade them a lot. They're a lot cleaner, I think, than a lot of the equities markets. So, very difficult to get that point across. But the liquidity, The cleanliness of the product is probably, it's as close to 24/7 availability as you can get. And I think it's getting even wider. I talked about the grains. I'll ask you this question. Do you think the grains are coming to a more 24/7 model? And along with a lot of the other futures, oil's there, gold's there, the financials, the interest rate products are all there, the currencies are all there. So are the grains next? Are those going to be 24/7?
I think so. That's pretty much the next step. And as commodities just become a bigger and bigger focus for a lot of people, I think just the market demand will also force it to occur.
So give me a couple, one or two nuggets, the future on futures, if you will, kind of what you see out there. Give me some trends that you're watching or, kind of keeping an eye on that maybe other folks should, at least start to hone in on a little bit.
You mean as far as the industry goes? Or?
Sure. Anything you want to talk about, anything that, things that you think are growing or changing or in the works out there.
Well, definitely within the industry, as I mentioned, since about 2008, a lot of people are very much becoming much more serious to invest, or at least look at it and understand the product. There's more money flowing into it. People are starting to realize that 60-40 model isn't enough. Even just using hedge funds, as a lot of hedge funds also went down in 2008, at least as an industry. There were some that did pretty well, but as an industry, it didn't do what people thought it should do.
Right.
So where do you look next? So you look at CTAs. So there's this growing demand, there's this growing need to understand the product, understand how does it fit into a portfolio, whether it's for a retail investor or it's for a pension fund.
Right.
It has a potential place for it. So you definitely have that. So I think you're going to continue to see that grow. As that grows, you're going to see more liquidity and more volume coming into the futures markets as well.
Yeah. So again, opportunistic ideas and chances for both investors and for traders. I would say to hone in on these skills and these markets because of the things that Mark you have mentioned trade much differently than if you're just coming from the traditional portfolio management of equities and options. These things trade a lot different, and there is definitely a learning curve, obviously, that folks can get from talking to people like yourself and taking courses that talk about, as you said, Skew and the tales that happen in futures. They're very real, but the liquidity of these products really provides this great opportunistic pieces for traders out there, I think.
Yeah, and there's a paper that I wrote about 5 or 6 years ago called Skewing Your Diversification. And it actually talks about these concepts and talking about the tail risk, the skewness. Also, Sharpe ratio is not particularly a good metric to use, which a lot of people use. Even Sharpe himself had said, if you're not using anything, any kind of metric for risk, then it's fine. Once you get beyond that, there are other things that are better to use.
So, since you brought that up, what would you say are better uses when it comes to the futures world?
Well, one of the more popular metrics that are out there is the Sortino ratio, which instead of using the full standard deviation, it uses the downside deviation.
Okay.
So that gives so you're really basing your returns against the downside, opposed to the full standard deviation, because it's making assumption that you don't have normal distribution, that there is skewness in there. There's also something that I had worked on some years ago. It's also in the Skewing Your Diversification paper. I refer to it as the S ratio, standard deviation ratio. And same thing, it's just saying you're parsing up your standard deviation, saying your upside deviation versus your downside deviation. If it's greater than 1, it's saying that you've got more volatility to your upside. So having greater volatility isn't necessarily a bad thing.
Right.
So that just starts to open up the discussion about things you should be looking at and ideas to be discussing and to be thinking about when you're looking at returns.
Yeah. And Mark, is that paper available? Can people find that online?
Yeah, they can actually find it on my site.
Okay. So it's on so Mark's site, just for everybody, I'll drop it in real quick here, is www.shorecapmanagement, shortened MGMT.com. So you can go to Mark's site, and it's under, I'm sure, your research links and books, headings there. I'm looking on the site right now. So, well, Mark, this is fascinating. And again, this is a subject that I'm passionate about, and I think more people are obviously sitting in on your courses, and you're going to have an expansive offering, I'm sure, not only at DePaul, but you mentioned that you're doing some time in China. What's going on there? Are you teaching at a university in China?
There's a possibility, that I might be going to China either later this year or next year to do some presentations, some workshops. There's a growing demand coming out of there as well.
Yeah. Is it coming from their, again, university settings, financial markets, both, everywhere, even, companies that are hedging their risk, that type of thing, hedgers versus speculators? There's a lot of different ways this stuff can be utilized beyond CTAs, obviously.
Yeah, I would say it's across the board, a little bit of everything where there's showing demand and interest to understand the product.
Okay, well, good, Mark. I appreciate it. Continued success. Mark Shore of Shore Capital Management out of the north side of Chicago. And you can also follow Mark at ShoreCap on Twitter. That's @Shore, SHORE, like his name here, Cap. And Mark, I really appreciate you coming on today. I'd like to do this, maybe get into some more specific topics in the future, and we'll have you back on if you'll be so kind. Appreciate it.
Sure, I'd be happy to. Thank you very much, Matt.